Before I go into my reading today, I wanted to give what I consider after 30 years of basically investing. I wanted to give my advice on what I think is the easiest way to explain how to be successful in the stock market. Um, First thing a person should do is look around and identify a company that they believe that will be around for 50 years from now. That's real dominant in the marketplace. Just to name a couple right off my head, got Apple, Google, Microsoft. These companies are dominant. They're technology companies. There's also other dominant non-technology companies that can make good sound investments. But those companies have, if you ask my opinion, they'll be around 50 years from now. They're dominant in their areas that they're in. And the next thing to do is to buy them at good prices. What's a good price? You can always normally get a good price when we have a down stock market like we do now today on January 4th of 2023. We have a market that's down over 20%. There's some good investments out there. Microsoft is really down a lot. So that's a way to buy a stock or at a good price is when the market is in a downturn. You just got to have the courage to be willing to do it. And after you purchase that stock at a low price, all you have to do is monitor the company, make sure that the company is keeping their dominant position in the marketplace. That's the easiest way to explain how to become successful in the stock market. If you do that, I believe that you will outperform the stock market. Now we're going to go on to the intelligent investor and some of the sentences that I find that I highly recommend. We recommend that the investor divide his holdings between high grade bonds and leading common stocks. With most times the portion being 50-50. And the reason why Graham say that is it's easier to control your emotions if you have a bond portfolio and a stock portfolio. Let's say if you believe the market is fairly valued, you should probably be 50-50. If the market is down, as we are now, which we may go lower, you should probably be 75 stocks, 25% bonds. If the market is high, as we were at the beginning of last year when speculation was real high, you should probably be 25% stocks and 75% bonds. And that will allow you to control your emotions, still being invested. And so let's say when the market was high last January, or January of 2022, when the market was high and you was 75 bonds, 25% stocks, as the market started to drop, you can change your allocation, start selling some of those bonds and moving them over to stocks. Okay, the second one is the implied that in normal levels of the market, investors should be able to obtain an initial dividend return of 3.5% or 4.5% on stocks, to which should be added steady increase in underlying value. So I thought that was important because this is an interesting time in my investing career. The majority of the time in my investment career, you really couldn't get hardly no return on bonds. I haven't owned a bond in a very long time. I just actually started purchasing bonds lately as the Federal Reserve increased the bond rate, because I kind of still think the market may come down some, even though I'm also purchasing stocks. But then on the dividend side, this is the highest return on dividends that I could see, because companies were raising their dividends as companies were performing well, and now that the stock market has turned, most of them haven't lowered their dividends. So if it's a good sound company, you can get a nice dividend. There's a lot of them out there. I mean, Intel, which depending on your outlook of semiconductors, it's up to about a 5% dividend, something I've never seen. I was purchasing the banks about 4 months ago. They all was returning really good dividends, 5% dividend on bank stocks, which I really like bank stocks. I believe banks are always a good long-term hold if you can purchase at the good price. That's our reading for today. I hope you enjoyed it. If you like this content, please subscribe and please like. Thank you very much.